Turning to this article at CNBC.com, there's a currency expert who says there's one fundamental reason behind Bitcoin's runaway rally. Valentin Marinov, who says that it's the inherent imbalance between the demand and supply. There's only so much Bitcoin. There's currently 16.7 million Bitcoins. And the demand is not even at 1% of the world's population. It's less than 1% of the world's population, less than 1% of the world's currency money supply, and the sky is the limit. So cryptocurrency scarcity and that value of the scarcity is a primary reason for the staying power, is a primary reason why even if people say Bitcoin is dead, people are still going to hold on to Bitcoin. And unless there was a fundamental disability or destruction of the blockchain and the security or the trust, people would refuse to sell Bitcoin at almost any price. If you had the opportunity to purchase 1 million Bitcoins, the Bitcoin price crashed and everyone said Bitcoin was dead, and you had the opportunity to purchase 1 million of them, would you? Because if everybody wanted 1 million of them, if there's still that level of demand, then that is going to keep the price up. And so while that's the case, we still have a lot of people who are saying that, you know, to stay away from it, saying that it's a mirage, saying that it's a fraud. People like Warren Buffett, people like Jamie Dimon at JP Chase. And so there's on one hand, there's this imbalance between the supply and demand. And on the demand side, there's just this unwavering hope, this unwavering faith, this unwavering knowledge that the digital currency's value is going to go up, that the trust and the security will be maintained, that the issues that plague Bitcoin and Bitcoin's blockchain now will be resolved, and holders of the primary level protocol, in the case of Bitcoin, Bitcoin BTC, and in the case of Ethereum, Ethereum ETH, they're going to be the ones who will have the most rewards, as people down the line will be primarily focused with the tokenization of the secondary levels of this blockchain technology. So in terms of the futures are derivatives. And so what's a derivative? A derivative is a debt. And so when someone says they're talking about futures, which is a very big word in finance, it is a megalithic sort of concept, because our entire world, our entire society, all business structure, all money supply, all structure of money and regulation is all built on the concept of futures and forwards contracts. And so none of this is financial advice, just to make sure that's said out there. But this is just some educational information. Please check all of my facts, check out, your sources, and don't make any investment decisions based on any of this. So when someone is talking about futures, they're talking about debt. When someone is talking about a derivative, they're talking about debt. And what this means, it's a financial instrument, and it obligates a trader to either buy or sell an asset. And they have to buy or sell this asset at a specific time and at a specific price. And that's very, very important, because you're not buying or selling that trade based on today's price, because that's just normal trading. This is a derivative. This is, you're making a debt. You're giving up money to say that you're going to buy or sell this at a future price. And so the way the futures derivatives work at the CME and the other places like the CBOE and what will be the New York Stock Exchange when they release their Bitcoin futures as well, or any place that really has futures, because like the CME, for example, they've been in the futures industry for a long, long time, and they've been creating futures contracts for a long, long time, not necessarily for institutional investors to create incredible amounts of wealth, but really to help the market in terms of the producers to hedge against the potential of losses that could exist in markets that originally required futures, such as food, water, things like that. And now there's this crazy Bitcoin futures just so these people can make some money and hopefully try to stabilize the price. A lot of people staying away from it. Again, Warren Buffett, Jamie Dimon. It's really interesting that Warren Buffett says stay away from it. I really thought that he would see the value and see the potential based on his understanding of the market. I wonder if he really doesn't understand Bitcoin, or I wonder if he is encouraging people to stay away from it because he understands the negative effects that would have for the rest of his portfolio. I guess we really won't know, what his intentions are since we're not in his business circle, but just something to think about. So this currency expert goes on to say that the reason why there's so much concern around Bitcoin is because of the high volatility levels. And it's also the clear lack of support from either central banks or international regulators. And so what this means, the reason this is highlighted is that this is information that you want to be aware of. These are clues that you want to pay attention to. Whenever someone is talking about the high volatility levels of Bitcoin or blockchain technology, if there's an extreme shift with the volatility going down, that can be used against Bitcoin and blockchain technology. It can be used to implement different types of regulation, just as if there's a big incident in the world, that could sort of rally people's attention and rally lawmakers to create different laws. And so the volatility inside the Bitcoin, the volatility in the markets, is used as a bad word. But in terms of the financial traders, in terms of the people who are buying and selling, these guys, they're looking for the volatility. They want the volatility. They want these huge swings up and these huge swings down, because that's how they make all of their money. It's also interesting, with a clear lack of support from either central banks or international regulators, we know that there's more and more interest in regulating the technology and trying to figure out how do you take the existing technology that has now been created with blockchain and Bitcoin, and how do you fit it into the box of the existing laws and regulations when this doesn't quite fit into any of those different boxes. So this brings us to Metcalfe's law. So we were talking about Metcalfe's law in yesterday's show. And so just to review, Metcalfe's law states that the value of a telecommunications network is proportional to the square of the number of connected users of that system. And if we go, we can check this out a little bit more at Wikipedia. Metcalfe's law has been used to help define the value of different telecommunications networks like telephones and faxes. You probably heard it in relationship to them. And for example, in the telephone example here, you can see if you have 2 telephones, then you can only make 2 different connections. And if you have 5 telephones, then you can make 10 different connections. And if you have 12 telephones, then you can make 66 connections. And so the value of the network in total is completely dependent on the total number of users who are using that network. And so in terms of the Metcalfe's law and Bitcoin, a lot of people we know are using this equation to help them understand if the price of Bitcoin is going to go up or if the price of Bitcoin is going to go down. They're using Metcalfe's law while also looking at the hashing rate and the amount of hashing power that's going into Bitcoin toward Bitcoin. And so what does this mean? And so the interesting aspect about Bitcoin and blockchain technology that I want to bring to your attention is that if you have telephones or if you have Facebook users, then the total number of telephones or the total number of Facebook users is practically infinite in terms of the total supply of the society. You can say 100% equals infinity. And so with the Bitcoin and with the blockchain technology, I suppose you could have infinity users using the Bitcoin and the blockchain technology, but you don't have infinity supply of the amount of Bitcoin that actually exists. If you're someone that wants to try to calculate Metcalfe's law for Bitcoin and you want to figure out, what are the total number of users so you can square that for the value of the system, you have to figure out how do you calculate the total number of users. And is the total number of users the total number of Bitcoin addresses? Is it the total number of Bitcoin addresses that have 0.1 Bitcoin? Is it the total number of Bitcoin addresses that have 0.1 Bitcoin divided by the number of transactions that's been taken in a period of time? And so the reason why I'm sort of jamming about these sort of ideas is because I just wonder, is Metcalfe's law actually liberal in its valuation of Bitcoin? I wonder if it's the opposite of the limitations. So in terms of the limitations of Metcalfe's law in social networks, if a user joins later, and they later use the network, and they use the network less than the early adopters, then the benefit of the additional users may lessen, making the overall network effect less efficient if it costs, per users are fixed. And so the cost per users isn't necessarily fixed with Bitcoin because, again, this total supply creates different market dynamics. And so this is something I'm really interested in talking more about. This is something I'm really interested in. And if this interests you at all, then I encourage you to come to our Discord channel and start talking about this, because I want to see if we can actually work on our own equation and see if we can find some equations that are out there, and just see if we can have our own little predictive analysis of how we can sort of validate our predictions after they happen with Bitcoin.